This is critical. Silver just had a massive shift. Something just changed in the silver market. And the analysts, they are not agreeing anymore. One side is screaming $50. The other side is quietly whispering 500. The same metal, the same data. Two completely opposite conclusions. And right now, somewhere between those two numbers sits every dollar you have ever trusted to hold its value. And Wall Street just flipped. The supply chain just cracked. And the US dollar is doing something it has never done before. What Jugan is about to show you could change the way you see money forever. Welcome to CSC-Alert, where serious money conversations happen and where the truth about gold and silver is never dressed up in noise or nonsense. If this is your first time here, you have just found the right room. Now, before we go any further, if you are over 50 years old, you already know that time is the most valuable thing a person owns. So do not waste another second. Go ahead and hit that subscription B button right now. Think of it like locking the front door before you go to sleep. It just makes good sense. And for everyone who has been with CSC-Alert for a while, welcome back. Jugan is glad you're here. And what is coming up in today's video is something you genuinely do not want to miss even 1 minute of. One quick thing before we dive in. Drop a comment below and let us know where in the world you are watching from right now. Whether you are in Texas, Toronto, Karachi, or somewhere in between, CSC-Alert wants to know. This community spans the globe, and every single voice in that comment section matters. Now let us get into it, because what just happened in the silver market is not a rumor. It is not speculation. It is data, and Jugan is going to walk you through every piece of it step by step, starting right now. Jugan opened the conversation with a simple but striking observation. Something unusual was happening in the silver market, and it was not just about the price. It was about the people watching the price. For the first time in recent memory, the analysts were not even close to agreeing. Not slightly different, not a small margin of error. The divide between where experts believed silver was heading had grown into something that Jugan described as genuinely historic. On one side of the argument stood analysts projecting silver at $300 to $500 per ounce, possibly within the same year. These were not fringe voices. These were serious, well-researched professionals pointing at real data and drawing extraordinary conclusions. On the other side stood analysts moving in the exact opposite direction. They were warning of a pullback, a cooling period, and the possibility of silver sliding back toward $50 per ounce. Same market, same numbers, completely different conclusions. Jugan had recently received a private message from one of the most respected minds he knew in the precious metal space, a person he referred to simply as Mr. M. This individual had spent decades studying metals markets with discipline and precision, and even he had never seen anything like this before. Mr. M described it this way. He had never witnessed such massively divergent yet concurrent short-term predictions for silver in all his years of following the market. The word concurrent was important. These opposing predictions were not separated by time. They were happening simultaneously right now in the same moment. Jugan paused on that point because it mattered deeply. When the smartest people in the room cannot agree, that itself becomes the signal. It means the market is sitting at a genuine crossroads, and the next major move could be extraordinary in either direction. But here is where Jugan shifted the conversation towards something more grounded. He introduced what he called the asymmetric opportunity. Even in the absolute worst-case scenario, if silver dropped all the way back to $50 per ounce, the damage, while painful, would be limited compared to the potential. Teal on the other side. Think about it carefully. If silver falls to 50, that is a loss. Nobody celebrates a loss. But if silver climbs to $150, $200, $300, or even $500 per ounce, that upside is not just larger. It is incomparably larger. That gap between limited downside and enormous upside is precisely what the word asymmetric means. Jugan was direct about his personal position. He did not believe silver was going back to $50. He was not building his strategy around that outcome. But even acknowledging it as a possibility, the math still told a compelling story in favor of holding and staying patient. This was not emotional thinking. This was not hope dressed up as analysis. This was basic mathematics applied to a real market situation, the kind of thinking that serious investors and business-minded individuals rely on when noise surrounds every headline. Jugan then welcomed his audience to what he called the basement. It was his way of describing a community of people who understood silver and gold, not because of trends or social media hype, but because they had studied history and trusted mathematics above all else. The basement, as Jugan described it, was not a place of pessimism. It was a place of clarity. The people who gathered there were not gambling. They were positioning patiently, deliberately, with a long-term view rooted in facts rather than feelings. He reminded his audience at CSC-Alert that what was coming next in the video would cover what Wall Street was actually saying, not rumors, not summaries, but direct statements from analysts inside the institutions that move markets. That information was worth paying close attention to. And with that, Jugan set the stage. The silver market had just shifted. The argument between analysts was real and growing louder. The asymmetric case for silver had never been stronger. And the most important data, the kind that changes how serious people think about money, was only just beginning to surface. There's an old saying in financial markets, when Wall Street changes its mind, pay attention. In this particular week, Wall Street changed its mind loudly, clearly, and with conviction. Jugan wanted his audience at CSC-Alert to understand exactly what that meant and why it mattered. The gold market had just survived one of its most turbulent weeks in recent months. The spot price opened the week at $4,458 per ounce on Sunday evening. What followed was not a clean, comfortable climb. It was chaotic, unpredictable, and at moments genuinely alarming. Gold hit its weekly low at $4,365. For a brief moment on Friday morning, it sliced through the 200-day moving average, something it had not done in 2 full years. To technical analysts, that kind of break is not a small event. It is a warning signal that triggers selling pressure across the board. But then something unexpected happened. Gold did not collapse. It recovered quietly at first, then with growing momentum. By Friday's close, gold had surged to its weekly high of $4,594 per ounce. The week that looked like it might end in damage ended green. Jugan pointed to the Kitco News weekly gold survey as the clearest evidence of what this recovery meant to professional investors. 12 Wall Street analysts participated in that survey. The results were not subtle. Wall Street had flipped firmly bullish on gold's near-term prospects. The pessimism that had been building quietly in the background had been replaced by fresh, renewed confidence. What made this more interesting was the contrast. While Wall Street turned bullish, Main Street, everyday retail investors moved in the opposite direction. Sentiment among ordinary investors had slid into bearish territory despite gold's recovery. Jugan noted this contrast carefully. History shows repeatedly that when Wall Street and Main Street disagree, it is usually Main Street that gets proven wrong. Analyst Mark Chandler pointed to the ceasefire discussions between the U.S. and Iran as a key driver behind gold's recovery. His reasoning was precise. An extended ceasefire removes a potential source of forced gold liquidation from oil-exporting nations that may need emergency liquidity. He added that a move above the $4,585 level would significantly improve gold's technical outlook. Rich Chekin, president of Asset Strategies International, reinforced that view. He stated plainly that if the ceasefire rumors proved accurate, both gold and silver should rise as a direct result. He noted this had been the consistent pattern observed since February. Geopolitical tension driving precious metals behavior month after month. David Morrison of Trade Nation described Friday's gold session as quite a journey. The early breakdown below 4,400 looked dangerous, but a modest pullback in the US dollar gave gold the breathing room it needed. From that point, the recovery accelerated sharply, turning a potentially damaging session into a statement of resilience. Bob Habercorn of StoneX delivered perhaps the most important assessment of all. He remained firmly bullish on gold's longer-term direction. He acknowledged short-term sideways pressure, but emphasized something critical. The way gold and silver were holding above key support levels was itself a bullish signal. Markets that refuse to break down under pressure are markets building energy for the next move up. Habercorn also identified a specific date that serious investors needed to mark on their calendars, June 17th. That was the date of the first Federal Reserve meeting under the new leadership of Kevin Walsh. The tone Walsh chose to take, dovish or hawkish on interest rates, would send a direct signal to gold and silver markets about what was coming next. Jugan then moved the lens towards silver specifically. On the CNBC chart for July, COMEX silver futures, one pattern stood out above everything else. Since mid-March, nearly 3 full months, silver had been hugging the $75 range with remarkable consistency. It had briefly spiked toward $90, giving the market a glimpse of what was possible, but it always returned to that $75 base. Jugan described this pattern using one precise word: coiling. Like a spring under pressure, silver had been compressing energy at that base for months. Everyone who wanted to sell at $75 had already sold. The holders who remained were not nervous hands. They were patient, informed, and fully committed to where this metal was heading next. And then Jugan introduced a number that reframed everything: $388. That was not a prediction. That was a calculation. And what it revealed about the silver market was something that every serious investor at CSC-Alert needed to hear. Numbers can be manipulated. Narratives can be shaped. Headlines can be written to serve any agenda. But there is one thing in any market that cannot be faked, cannot be spun, and cannot be argued away: physical supply. And when Jugan turned the conversation towards silver supply, what he revealed was not a thing. It was a structural crisis hiding in plain sight. James Anderson from SD Bullion had published something that stopped serious analysts in their tracks: a world market clearing price calculation for silver, not based on sentiment, not based on speculation, but based on actual trading behavior across decades of real market data. The number he arrived at was $388 per ounce. The methodology behind that number was both simple and deeply revealing. Anderson tracked what would happen to the silver price if you remove the New York paper market trading window entirely. From 8:20 in the morning until 1:30 in the afternoon, that specific window when the COMEX and LBMA were actively trading, the silver price was consistently pushed downward day after day, year after year. But the moment that window closed, the moment the paper market stopped trading at 1:30 in the afternoon, silver began recovering. If an investor had bought silver at that 1.30 close every single day, held it overnight, sold it at 8:20 the following morning before the paper market reopened, their accumulated silver price would sit at $388 per ounce today. Jugan let that number settle. $388, not $500. Not a dream figure pulled from optimism, a mathematically derived price based on removing a specific period of what the data strongly suggested was systematic downward manipulation of the silver market. The black line in Anderson's chart told the other side of that story just as powerfully. If an investor had done the exact opposite, buying only when the New York market opened and selling at its close, their accumulated silver price would be approximately 50 cents per ounce. 50 cents, the same metal, the same years. The difference was simply which hours you participated in. Jugan did not need to editorialize. The data spoke with more authority than any opinion could. The paper market had been used as a pressure valve against silver for decades. And the physical market, the real tangible dig it out of the ground silver market, had been quietly building a crisis that was now becoming impossible to ignore. Kenway's supply analysis brought that crisis into sharp numerical focus. A 46 million ounce silver deficit was projected for 2026. Jugan believed the real number would be even higher. But even the conservative projection painted a picture of a market where demand was structurally outpacing everything the world's mines could produce. The reason for this came down to geography and economics. 70% of the world's silver does not come from dedicated silver mines. It arrives as an accidental byproduct of mining other metals entirely: copper, lead, zinc. Silver is almost an afterthought in most mining operations. You cannot simply decide to produce more of it because the price rises. The infrastructure does not work that way. Mexico and Peru together accounted for nearly 40% of global silver mine production. And both countries were facing mounting pressure, political instability, regulatory uncertainty. uncertainty, and operational challenges that were making consistent output increasingly difficult to guarantee. 40% of global supply sitting on unstable ground was not a minor concern. It was a systemic vulnerability. Jugan explained the timeline reality that most outside the industry failed to appreciate. From the moment silver is discovered in the ground to the moment it reaches the market as a refined product, the process takes a minimum of 10 years. 10 years of drilling, permitting, financing, building, and testing before a single ounce enters the supply chain. There was no shortcut. There was no emergency lever to pull. This was the structural trap that silver found itself in. Decades of artificially suppressed prices had starved the mining sector of the investment capital needed to develop new projects. Exploration budgets were cut. New mines were never built. The pipeline that should have been filling for the past 20 years was nearly empty. Doug Casey, one of the most respected and longest-serving voices in the precious metals sector, described the current situation with characteristic directness. He appeared in a widely viewed interview and made a statement that Jugan found both accurate and historically significant. The public hated gold mining. Fund managers avoided it. Environmental concerns surrounded it. And that collective hatred, Casey argued, was precisely why it represented one of the most compelling opportunities available to serious investors today. Casey went further. He explained that silver was no longer simply a monetary metal competing with gold for investor attention. It had evolved into something more complex and more strategically valuable, an industrial metal with properties that no other element on the periodic table could replicate. The most reflective of light, the most conductive of electricity, the most conductive of heat. 3 superlatives, one metal irreplaceable in solar panels, electronics, medical equipment, and defense application. And then Jugan introduced the scenario that brought everything into perspective. When the mainstream investor, the one who had ignored silver for decades, finally woke up and decided to enter this market, what would happen? Casey had answered that question with an image that was difficult to forget. It would be like trying to drain Hoover Dam with a garden hose, an ocean of capital chasing a market so small it barely registered as a rounding error in global finance. CSC-Alert's audience was not that mainstream investor. They were already inside the room. And what was coming toward that room from the supply side, from the deficit data, from the structural collapse of new mine development was not a wave. It was something considerably larger than that. Every great financial storm in history has announced itself quietly, not with sirens, not with breaking news alerts, but with data. Slow, steady, accumulating data that most people ignored until it was far too late to act. Jugan had been watching that data carefully. And what he was seeing in the United States economy right now was not a distant warning. It was an active signal demanding immediate attention. The first piece of that signal came from personal spending and income data. In the United States, personal spending was surging while income growth was collapsing simultaneously. These two lines, one rising, one falling, were moving in opposite directions at an accelerating pace, and the gap between them was being filled by one thing only: savings. Americans were draining their financial reserves to maintain a lifestyle their income could no longer support. 1 year ago, the personal savings rate in the United States stood at 5.12%. A modest number, but a functioning one. Today, that number had collapsed to 2.6%, nearly half of what it was in a single year. A 3 percentage point plunge that almost nobody in mainstream financial media was discussing with the seriousness it deserved. Jugan referenced a prominent CNBC analyst who described this savings rate collapse as one of the most critical behavioral indicators in the entire national accounts framework. When an economist of that caliber calls something the most important signal in mainstream audiences still glaze over it. That is precisely the kind of disconnect that creates catastrophic surprises in financial markets. The mathematics were straightforward and unforgiving. When a household spends more than it earns, the difference must come from somewhere. First, it comes from savings. When savings run dry, it comes from credit. And the credit data that Jugan presented next removed any remaining doubt about where the American consumer currently stood. Credit card debt held at U.S. commercial banks had reached $1.09 trillion, a record that had never been touched in the entire history of the United States financial system. To understand the scale of that number, consider this. In 2010, just 15 years earlier, that same figure stood at $300 billion. And it had more than tripled in 15 years, and it was still climbing. What made that debt genuinely dangerous was not just its size, it was its cost. The average commercial bank interest rate on credit cards was sitting at 21%, near the highest level recorded since data collection began in 1994. Americans were not just carrying record debt, they were carrying record debt at near record interest rates. Every month that balance remained unpaid, the hole deepened automatically. Jugan connected these two realities, collapsing savings and exploding high-interest debt, to a third data point that completed the picture. The U.S. stock market had reached a total market capitalization of $75 trillion, a number so large it had lost its meaning for most people. But Jugan broke it down in a way that made its fragility impossible to miss. The entire U.S. equity market was now more than 5 times larger than China's, the second largest market in the world. The United States alone held more stock market value, UE, than the next 9 largest markets on the planet combined: China, Japan, India, Canada, the United Kingdom, France, Taiwan, South Korea, and Hong Kong. All 9 together still fell 17 trillion short of the U.S. market alone. Jugan was careful to explain what that number actually represented. A stock market valuation is not a vault of money sitting somewhere waiting to be claimed. It is simply the price of the last traded share multiplied across all existing shares. When confidence shifts, when sentiment turns, that $75 trillion figure does not slowly shrink. It evaporates with speed that most investors are never psychologically prepared for. And sitting beneath all of this was the inflation data that tied every thread together. In February, inflation in the United States had registered at 2.6%. By April, that number had risen to 3.8%, a significant jump in a very short window of time, and the direction of travel was not encouraging. Jugan explained the Federal Reserve's position with clinical precision. When an economy begins straining under the weight of consumer debt, collapsing savings, an overvalued stock market, and rising inflation simultaneously, the options available to central bank leadership become extremely narrow. The Federal Reserve's most accessible tool in a crisis was also its most destructive one: printing money, expanding the supply of dollars to keep the system functioning. But every dollar printed was a quiet tax on every dollar already in existence. When the supply of money increases without a corresponding increase in real economic output, the purchasing power of each existing dollar declines. That decline had a name that every person in Jugan's audience already felt in their daily lives. Inflation, not a financial abstraction, a real measurable reduction in what a family could buy with the same income month after month. This was not a new story. Jugan reminded the CSC-Alert audience that this precise sequence, debt expansion, currency devalue, Asian inflation acceleration, had repeated itself across civilizations for 3,000 years. Empires had risen and fallen following this exact pattern. Currencies had come and gone. Financial systems had been built, overextended, and collapsed more times than history could comfortably count. And through every single one of those cycles, silver and gold had done the same thing. They had held their value not because of sentiment, not because of marketing, but because their supply could not be printed, their properties could not be replicated, and their track record across millennia was, as Jugan stated plainly, perfect. The audience at CSC-Alert was not being asked to panic. They were not being invited into fear. They were being handed data, real, verifiable source data, and trusted to draw their own conclusions as serious, informed individuals. The dollar was weakening by design. The consumer was stretched beyond historical precedent. The stock market was valued at levels disconnected from economic reality, and silver, quietly coiling at its base, structurally undersupplied, mathematically underpriced, and historically proven, was simply waiting for the rest of the world to catch up with what the data had been saying all along.